Good afternoon, everybody, and thanks for joining us here today for this first half results update for Metro Mining, which will be presented to us by the CEO, Simon Wensley, and the CFO, Nathan Quinlin, who's also joined us here. There'll be opportunity for some questions at the end, and we look forward to delving into the good news. Simon, I'll hand it over to you.
Great, thanks, Peter, and hello to everybody. Thanks for all of your support and your interest in Metro Mining. So we've, as you would know, we've just launched our half-year results. Obviously, the physicals were quite well flagged in the quarterly results from quarter one and quarter two. And of course, the first half contains a quarter in which there are zero or very low numbers of sales. So with all that in mind, though, I'm very, very pleased with the results that we've brought back in the first half of this year. And indeed, I think from my point of view and from the team's point of view, we would say that the hard work that's gone into the market, into the business, by all of our team has paid dividends, and the turnaround that we've been trying to implement is now largely complete. So the foundation for our expansion is firm, and it's ready to. We are in the process of launching that expansion. So from that perspective, a pleasing set of results in which almost every element, from revenue through to our costs in every sense, was better than in previous quarters over the last 2 years, previous halves, and also bodes well for the future. This presentation is on the ASX and also on our website, so I'd encourage you to have a look at it there during and post the meeting. There's obviously a standard disclosure statement here, which I'd encourage you all to read. And firstly, we'll actually talk to the results themselves, and for this, I'll pass across to our CFO, Nathan Quinlin.
Cool. Thank you, Simon, and thanks to everyone who's joined. As Simon said, it's obviously been a really pleasing half year. For those who have had the opportunity to follow our disclosures over the past few months, you'll be well aware that it's been a very pleasing half year from a production perspective. So obviously, from a first quarter perspective, as Simon has touched on, we're in wet season, so there isn't any production to speak of, but otherwise that 3 months proved to be a very, very productive period for us, as we sort of went through some pretty full-on remediation programs on our land infrastructure, as we started to cut into some of that maintenance deficit that we spoke about a little bit last year. And so it's pleasing to see, as we moved into Q2, to see the fruits of our labour start to come through. So it's been a very pleasing quarter from a production perspective. So naturally, what you're seeing is that manifesting in the financial results for the first half. Very pleasing to see from a gross margin perspective, almost breaking even after 3 months of no production for the first 3 months. I would just point out that, and it's something that we have flagged a little bit in the last couple of releases, around the change in composition between our FOB and CIF pricing, makes it a little bit difficult on an apples for apples basis to compare some of the revenue and cost of sales versus sort of 12 months post. But from a gross loss perspective, you can see obviously a much improved position. And then from an underlying perspective, after all the finance costs and corporate costs, almost a $13 million turnaround net year on year. So based on the Q2 production that we're seeing and the margins that we're generating, we're pleased to report that we expect to return to profitability in the second half of 2023. What you'll see, like I mentioned, from just given the first 3 months with no production, it can be quite difficult to look at some of these first half results and be able to divine exactly what's happened during the quarters. And so I actually find personally that it's a little bit easier to look at these things on a quarter by quarter basis, which is what you've got in front of you on these graphs. So looking at, I guess, our key financial markers over the last few quarters, being obviously site costs and FOB revenue and the resulting site margin, what you see there is a pleasing set of data in front of you. So from a site cost perspective, year on year, we're seeing in that first quarter around $26 a tonne being produced site costs. So versus 12 months ago at $28 a tonne, that's obviously a pleasing improvement. Like any business, we are seeing inflationary pressures on our business, particularly around labour and fuel and those elements. For the most part, particularly for a young operation, the best thing that we can do, particularly around escalations, some of which are more controllable than others, is really productivity measures. For what is ultimately still a young operation, where there is still some really good, pockets of productivity that we can focus on. To the extent that we can control our costs, that's really where we expect to be able to, I suppose, respond to some of those inflationary pressures over the remaining part of the year. From an FOB revenue perspective, you can see a pretty dramatic increase, 12 months on from where we were at. FOB revenue is obviously is a perspective of sort of gross revenue line less the freight commitments that we have in delivering. So like I mentioned, we're producing about half FOB basis, half CIF basis at the moment, but from an apples to apples basis, 12 months ago, you're seeing a pretty dramatic increase there in our FOB revenue from $25.50 AUD a tonne up to over $40 now. There is a little bit of foreign exchange movement in that, about 10% movement. Obviously, 12 months ago, the Aussie dollar was a little bit stronger than what it is, so there is about 10% of that movement is tied up in foreign exchange. But what we're seeing is versus where we're at 12 months ago, and starting to work through some of those contracts that were really crystallised at quite a low point in the market. We've now worked our way through those contracts and are starting to see the benefit of those increasing bauxite prices that Simon will no doubt touch on. From an ocean freight perspective, like I said, only about half of our production at the moment is exposed to that ocean freight. On a like-for-like basis, we have seen a decrease from around $18.6 a wet tonne 12 months ago to $16.5 at the moment. Like we've said in a couple of previous announcements, from a freight perspective, very little, I suppose, exposure for us as a business. We look to lock those freight positions in well in advance, and I think at the moment, most of our COAs go out well in advance of 2023 out into 2024. So from a volatility perspective, we don't see this as a major area of risk for us, just given we've otherwise locked those positions away. And then what you can see is obviously the resulting site margin. So a really pleasing site margin realised in Q2 2023 of $9 a tonne, which is really pleasing. So that's where we're starting to see the confluence of managed costs through greater productivity and greater economies of scale, and starting to realise some of those pricing benefits that have come through in the last 12 months. So good sign for things ahead. Thanks, Simon.
Great, thanks, Nathan. Yeah, I will touch on the market a little bit. I think we talk about we show this graph pretty much at every quarterly or release, and it's an important graph because it's got a lot of history in it. We can see the actual delivered prices for traded bauxite into China, so the clearing market on the coast of China effectively. So Guinea price has risen significantly since the start of COVID. There's a lot more spot action in that market, and the Australian price has taken a bit more time, but it's continuing to rise steadily as our contracts and those of the other Australian suppliers roll over. So takes a bit more time for that, for the pricing to flow through. But you can see, as in the previous graph, and Nathan touched on that, we are seeing prices run through, and we do have a different styles of contract linked to different things, but it's linked. This is a sort of an average or aggregate view of what's going on in the marketplace. So, and I think we'll continue to see that rolling through. The Chinese economy is still in a little bit of an uncertain space, and certainly from a construction point of view is not as strong as people might have hoped. But I have to say, having just come back from China, that the other aluminium areas, such as transportation, particularly EVs, batteries, you know, and indeed the renewable energy, so solar panels, wind farms, etc. As you travel outside the big cities, you start to see, whilst construction is weak, that you are seeing enormous amounts of development in these areas for the low carbon economy. So aluminium is still relatively strong, considering the fact that construction is a little bit down on where people might have expected it to be. That's resulting in continued strength in the alumina space, and so Chinese imports of bauxite are up again. Even though last year was a record in 22, they're up again about 10.6% to the half year. And alumina prices, our customers' prices, are rising again as aluminium demand flows through to alumina. Bauxite market prices, as you can see, are firm. You know, they're steady at the Guinea level. Australian prices are still rising, and Indonesia's bauxite ban has been confirmed, and there are no further shipments in the market from Indonesia. Domestic bauxite prices, so the Chinese bauxite prices that some of our customers also use to blend imported bauxite, is also rising considerably. So again, it's a sign that demand is strong and bauxite supply is tighter than the demand. So look, I still see an upside in this graph, which is the $20 differential between Guinea and the Australian price, which should continue to close to roughly $8 to $10 over the next sort of 6 to 12 months. So where are we in terms of the half year? We produced about 1.3 million tons in that second quarter of this year. That was even at that point a record. We've continued that momentum through July and August, producing about another 1 million tons in the 2 months. The 560,000 tons produced in August was the first month of our stepping up, and that again is a record. And you can see here that, look, we're planning to target roughly 650 to 700, or sort of 600 to 700 over the next 3 months, with a reflection of, I guess, increasing sort of weather impacts in December. So look, that top line will deliver us the 5 million ton sales, and we will get a real sense of that in September and October. And I think it reflects the incremental expansion strategy that we've put in place. So we haven't sort of waited for one big bang expansion. So the elements of our supply chain have been expanded in sort of in an order that made sense from a capital expenditure point of view and from a practicality point of view. So right the way from right now, we're seeing that pretty much all of our mining and hauling equipment is already expanded. The existing screens that we've been relying on have been performing above expectations, so that's testament to our maintenance and upgrade strategy that we've been putting in place. The BLF is already expanded to that 7 million tons, and then from a tug and barge and transshipping perspective, that is steadily rising as well, with additional tug arriving this month, which we've chartered. There's new barges arriving. There's one barge we've chartered in August, and another one arriving at the end of September. And transshipping perspective, the floating crane has been doing pretty good tons above, at the top end of its range, and we're supplementing that now with geared vessels. So that will be our base case as we move towards the end of the year. The new transshipper will arrive at some point in Q4, and I'll update the market when we have a more firm view of the dry docking and the mobilization to Australia from China. But certainly, as we as we sit here with all of the work planned for the for the first quarter of next year, when we are implementing the screens and commissioning all of our equipment. We're going to be ready at the end of March at the 7 million ton rate for 2024. The next slide. Yeah, so just a summary, I think, and we can get on to questions. So look, resource and an operating mine. So this is not we're not in a greenfield perspective. We've now been operating for 5 years and have a 15+ reserve life, but with additional upside from resources. Market and customers are in place, so contracts in place for this year, 5 million tons plus 6 million for next year. So the next couple of years already underpinned by baseload customers. We have a low risk and a low cost business model. So it's a simple mining operation. The transshipping has now been in operation at the site for almost almost a year, and we're seeing the benefits of that. And we're shipping into Cape-size vessels, so the only Australian operator that can do that. At 7 million tons, we do project we'll be at the bottom end of the cost curve. We've got a very good local dedicated workforce and a very high level of Indigenous participation, which we're very proud of. And we've got a good management team and a board that are capable of implementing projects like this one. So this is this is the right team to prosecute this expansion. And look, I think we've now have this transformational expansion underway. It's we're a few months into it, and it will steadily be put into place in time for Q2 next year. It's a highly value accretive expansion. It's relatively low cost. It's brownfield, and the technologies we're using are not high risk in any way. And now we have all the funding plus the cash flow that we're generating from this year, so we're very secure sort of next 6 months from a funding perspective. So we're very clear that we have the firm pathway to deliver on the expansion. Look, that's really a summary where we're at. I probably open up to questions, Peter.
Thanks, Simon. I'm going to kick it off. I think that this half has shown a tremendous turnaround, and you and the team obviously to be congratulated. And the share prices recovered quite well from a little dip in the last month or so. The market's happy to see that as well. But it was sort of struck me as we were walking through this presentation just now that shareholders probably and other people watching should be reminded that this is not a complicated mining operation. It's not a drill and blast and a complicated flow sheet. It's really just a screening process and load high quality bauxite through a simple loading process and shipping it. And you're receiving good prices for that product now. So talk to us a little bit about that process of going from the ore body that you're mining and has such a long life on it to the barge.
Look, this business, the business model, the operating model that we have is not that common in Australia, but it's incredibly common overseas. It's a scalable, operating model where you've got a near coast or near infrastructure operating mine, close to surface resource, so very little stripping. There's certainly no geotechnical risk. And we're not doing a great deal to the product. We're using our drilling, our grade control drilling to plan our production. We then screen and blend to meet customer specifications, but that's a relatively straightforward process. And then we're transshipping it to large vessels. So again, it's a relatively well-known operating model from other parts of the world. It's very scalable. It's relatively easy to monitor. So, and the technologies involved are all relatively well established. So, from both a current operating model, but also from an expansion point of view, it really does, it doesn't offer a great deal of risk. So, look, we obviously operate in North Queensland and in a place that's relatively remote, but that's really about organization, planning, logistics, in keeping the mine and our resources flowing, and getting people in and out of sites and all of those things. So, it is a relatively straightforward model, and I think from that perspective, the risk of us being able to sort of deliver on what we've talked about, I say is relatively low.
And Simon, the bauxite we're mining there and sending off to China, tell us a little bit about where we fit in world bauxite supply and what makes your product more attractive for those customers.
So look, the bauxite that we mine has got a very high alumina content. So alumina is the product that gets made out of our bauxite. And so the most important aspect of our bauxite is how much alumina is in it. And we have roughly a 51 to 52% alumina product that's mined from a very well-established bauxite province. So the Weipa bauxite plateau has been mined for bauxite for more than 60 years. So not only is there a well-trodden path of mining there, but also customers have had, all over the world, have had experience in processing this kind of bauxite. So the high alumina aspect of it is absolutely critical. The second most important aspect is how close we are to the market. So we're, within, just over a week's sailing from our key market. So, from a logistics planning, a logistics cost point of view, from a risk perspective, our customers see us as a highly attractive supplier. And that goes along with, I suppose, the Australian context of a very large, well-established, predictable mineral producer and exporter, which has been, going on for decades. So not just obviously bauxite, but coal and iron ore and all of those other things. So, it's a well-known and low-risk environment. And so from our point of view as Metro, we try to differentiate ourselves in terms of, our customer service our contract flexibility, our contract structure, the fact that we are able to deliver in very large vessels, which is sort of unique for bauxite out of Australia, and also, our technical service, very good local technical team in China that help our customers optimize the products that they, we're often blended with other bauxites, and that takes a bit of knowledge and technique to do so, and we provide that through our team in China. So look, it's a varied sort of proposition, and we're increasingly seeing a lot more interest and demand for our product. And as I said, having just been in China quite recently, there's a lot of interest in contracting out past our current sort of contract length, which goes into 2025, 26, 27.
I was muted. On that, Simon, we're commencing the ramp up quite successfully, and plans are in place, and infrastructure seems to be coping smoothly with that. Is there capacity to increase that production beyond 7 million tonnes into the future?
Yeah, well, in August, we saw about 100,000 tonne step up from the previous month's sort of averages. So that was pleasing to see. We should see a similar kind of step up again in September. That will take us into that zone where we're producing at that sort of roughly around that sort of 6 million tonne rate. The 7 million tonne rate won't be possible until we've got all of the new screens and the second transhipper is commissioned, but we'll be ready to do that. We are already looking at whether we can get beyond 7. I think the market is certainly there, Peter, in terms of demand. That's very clear to me. And so we're looking at that at the moment. And certainly, I'd say, look, incremental mining equipment, so a few more trucks and trailers required. And indeed, I think the biggest bottleneck is probably the barge sizes. So we're going to look at whether we can increase our average barge size, which is currently around 7,000 tons per barge. We're exploring the design of tailored barges for our system of 10,000 tons. That'll give us about a sort of 40% uplift on each barge going out of the river. So no need for any further tugs, or and our transshippers can certainly do that kind of tonnage. So I think there is a bit of stretch beyond 7. We have a mining license approval up to 10, but we're certainly already, let's implement this 6 to 7 first, and but we, our engineers are already turning their attention to a bit of creep above that.
Yeah, that was a question from an impatient but happy shareholder. Still staying on the supply-demand story, what do you see happening globally in terms of greenfields, brownfield sites coming on, expanded capacity? And do you see new players coming to the market? For instance, India's ramping up their industry. Do you see new market participants coming in?
Well, let me address the bauxite supply side first. So look, there are existing bauxite suppliers in the market. They tend to be in the Atlantic Basin, so they are already challenged by distance, the tyranny of distance, and therefore shipping time and shipping cost. So Brazil and Jamaica, for example, are potential marginal suppliers into this market, but they require very high prices to even be competitive here. So if the prices are at that level, then I'm not going to be, and that encourages the very high tail of a cost curve to enter the market, then I'm not going to be too disappointed, because it's a sign that market prices are continuing to be very high. More locally, Malaysia and Vietnam have small bauxite resources that can come to market, but again tend to be in small vessels and again at the margin. So there's not a lot of additional supply other than out of West Africa and out of Australia that I think can really supply this kind of expansion that we're seeing. In terms of alumina demand, obviously about 90% of the traded bauxite in the Asia Pacific goes into China. Middle East has a growing alumina refining industry. There's one large refinery there which will probably get duplicated. India is also a growing market. I think they are proceeding with first must come power generation, so they're investing heavily in power generation at the moment. Then comes aluminium smelting, and they will backward integrate into alumina refining. They do have some bauxite resources, but they're not particularly large or particularly high quality. So we do see, I think, less so in the next 2 to 3 years, but maybe in the 5+ year timeframe, we see India as a very prospective customer for our bauxite.
There's a question here about bauxite pricing, and I think it refers to the chart you had there. What do you see as the reason for the $20 differential in LT and HT bauxite, when historically the difference has been around 10?
Yeah, no, it's a really great question. Look, I think it's mainly to do with the contract structures that exist. I touched on the fact that Guinea has a much larger sort of spot pricing structure. So the tightness in the market much more quickly reflects into the price. And so you see individual cargoes setting that pricing, that marginal pricing structure. In Australia, the major suppliers tend to be much more fully contracted, and so the rollover that occurs, there could be quarterly or half or even 12-month contracts, and we've had and continue to have some of those contracts in our portfolio. So there's a much slower rollover, if you like, of aggregate pricing in those contracts. So as you see pricing, demand and supply result in tightness and pricing go up, it's a smaller proportion of the aggregate shipments that that end up getting affected. So over time, it will reflect, and you will see that gap closing. But it will take still more, a few more months to get there, as these sort of annual and semi-annual sort of type contracts roll over, and those prices get a chance to be reset to a much more value in use representative level.
The wet season on site. How wet is too wet to load? And do you have a specific cutoff date, or will you sort of play it by ear, so to speak, as to how much you can load with the changing weather conditions?
Look, in general, it's not the rain that completely stops us. It slows us down. It tends to be more the prevailing wind and wave conditions that make it effectively unsafe to operate the transshipping. And so the rain, what we're doing with the newer trucks and trailers, plus the screens, the wobbler screen we're putting in, makes us sort of more resilient. So we'll see less productivity decline with wet weather going forward from 2024. And we really mine to conditions. So it's if we can mine further, we will mine further into the season. But it's really when we see the trade winds sort of swap around, and we see the monsoon troughs in the northern, Indonesian equator region starting to drive waves from the north and northwest, and that creates wave conditions that at the moment, make it difficult to do the transshipping organization. The new transshipper, the offshore floating terminal, has operated in monsoon conditions more often, and so we know it does have a greater resilience to waves, but it will still there'll still be an upward cutoff. So look, in general, we work with all of our contractors and all of our teams on site to try to maximize the amount of time that we spend operating, but it has to be safe, and it has to be sort of cost effective, if you like, for us to be able to do that. So that balance is always in our mind. But look, in general, over the next few years, we're certainly looking to reduce the impact of that wet season by investing in these technologies that have more resilience, et cetera, et cetera. But again, to emphasize, it needs to be safe and it needs to be cost effective.
Getting down just a couple more here to round off. Labour has remained tight across the industry. Simon, can you provide an update on how Metro is coping with the employment situation, and if you're comfortable with the expansion plans and your labour market?
Yeah, good question. Yes, it is tight, and it's tight, generally across what you might call, the mining sector skills, highly skilled equipment operators and plant fitters and these sorts of things. So look, we've put in place, we're a smaller company. We've got one mine site. It does allow us to be a bit more agile and a bit more responsive. So we've tried very hard to be agile and responsive. We've changed hourly rates. We've also put in bonus schemes in place, and we've also, tried to reflect on I suppose the workforce, on the available workforce, that we have a very attractive place to work. It's a small mine site. Everybody knows each other. It's a good culture. We're driving change and productivity. It's a good feeling. It's a good place to work, and we're trying to get that message out there. So that helps retention, and also gains. We gain employees a lot from the word of mouth from other employees who talk about working at Metro. So our turnover has been relatively low. We've been sort of below 10%, which is pretty low for a FIFO operation in the mining space, and that's we're keeping up with that. From an expansion point of view, pretty much all of the workforce we need to run the expansion, other than the crew for the new floating terminal. Other than that, we pretty much have everybody that we need now on site. So we have the equipment there that we're running already, and so the crews are pretty much at full capacity. So we're not going through a big push for for those particular roles. But obviously there's a new transhipper to staff when she arrives later this year.
Just a couple more to round us out. What was your monthly run rate at the end of August in terms of production?
Yeah, we're getting close. Well, so our monthly run rate was so we hit 560,000 tons, I think, Nathan, in August, and we're steadily that was steadily rising through August in terms of run rate, and we're expecting to hit the 6 million ton run rate, if you like, annualized run rate in September. So we're seeing, for example, we just did 25,500 ton day yesterday. So that's again indicative of a 6+ million ton sort of run rate. So we're steadily seeing, as we're pushing the envelope in all parts of the supply chain, right the way through to the vessels. So we're starting to see that 6 million ton rate coming through on more and more days.
And the last question is sort of two parts. What's your plans for the balance sheet now that you're returning to profitability, and when does the dividend policy kick in?
Well, look, plans for the balance sheet. Obviously, we need to get through the expansion. Will be in place. Obviously, we've got to get through this next wet season. There's still more capital to spend on the wobbler and on the dry docking of the floating terminal, its commissioning and so on, and the installation of the screens. We've got that cash in hand, ready to spend. So we'll do that over the coming wet season, and then we'll start next year at that 7 million ton rate. So we need to then build up cash, and our intention is to start paying down debt around the middle of next year. And so we'll fairly rapidly start to pay down debt over the following sort of 18 to 24 months. So look, dividend policy, I guess if things go swimmingly well, we might consider that. We might consider that next year, but I doubt it. But look, it all depends on the cash flow generation next year.
Terrific, Simon. I think that's we've answered pretty much all the questions there. And if anybody has any further questions they'd like answered, please send them through to me. Simon will get them, and he's looking forward to making sure everybody has their questions answered. I think we can safely say that was a great result, well described and explained today. Thank you, Simon. Thank you, Nathan. And thank you to everybody who joined in. There will be a recording available at the YouTube site and the website as well for Metro Mining. Thanks, gentlemen.
Right. Okay.
Thanks everybody.